Good morning, listeners. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And it's the beginning of another week, but the updates of previous week still needs to be considered. It ain't like your hangover from your previous weekend's parties, but like an after effect. And we've had RBI hiking rates by 50 basis point, as mentioned in our previous commentaries, as well as the uh, jobs reports by the US economy. So, JK, I'd like to hear from you on those fronts, as well as what should we be watching out in the financial markets this week.
Hey, good morning. Welcome to the new week. Yes, of course, jobs report was all the focus, particularly after Biden mentioned it as the key point of the economy. In fact, he was saying US economy is not in recession because the job market is very strong. So from that perspective, uh, what we saw on Friday was a blockbuster, in fact. Report showed jobs rising more than double of expectations. Unemployment rate was at 3.5%, which was a pre-pandemic low, and also wage increases were higher than what the market was expecting. So it's rekindled the debate on 75 BP hike by Fed in September. Probability is now touching around 75%. I would say market reaction is less than what one would have expected, with the DXY rising just by 0.9%, yen contributing a lot to it, and euro still within the range, whereas yields have risen mainly in the short end. Once again, yield rising can be pinned down to the fact that they had fallen quite a bit on the last few weeks based on certain weak economic data. For me, two things stand out. The 2 to 10-year yield curve, which has steepened and at minus 45 is the broadest margin that we have seen in the last 22 years. So probabilities of 75 BP point going up to 75%, that's another point. Now, the market is also expecting a terminal rate to go to 3.6 from 3.4. But I take these expectations with a pinch of salt because these keep swinging from each data point, and really we are not in a settled zone as far as where the terminal rate would be and what a hike would be in September. There is a lot to consider before the September meeting, starting with the CPI this week. And market definitely wants to look at where it is, particularly after the recent big fall in the fuel prices. And also on Friday, we will have the Michigan sentiment as well as inflation expectation index. Both are very closely looked at by Fed, mentioned by Powell also in his speech. So nothing very conclusive about jobs. It is strong, no doubt. Some analysts are saying we have seen the best of it, and as Fed hikes into slowing economy in other sectors and also higher inflation, job creation is bound to come down in the coming months. So we'll just wait and see. Dollar obviously is still in the range. I'm thinking that dollar move recently is more driven by the positioning. Market is absorbing all the developments, including the Taiwan development, and not reacting much because it has likely lesser liquidity in the market. And we will probably see the exact trend, whether it is a continuation of the existing one or a new trend post first week of September. That's what I have seen normally. Uh, yeah, so let's keep watching the upcoming data this week. Uh, in Coming to our own economy, RBI stood pat, rising rates by 0.5%, which is not exactly a majority expectation. Repo now stands at 5.4, reverse repo at 5.15, and MSF at 5.65. The key factor, probably in my view, is rate action seems to be pivoted towards interest rate defense of the currency. I mean, RBI probably wants to keep the attractiveness of the rupee yield high so that the flows are intact, or rather there are no major outflows towards US. External balances are very important. So the concern on volatility and perhaps some resistance towards sharply depreciated INR, these things might have played its part. And because global central banks are still raising rates, RBI would continue this, apart from keeping an eye on the domestic inflation, but perhaps domestic inflation is not going to be such a concern as per many analysis. In fact, the projection on inflation and growth were maintained as expected in June also. So going forward, I feel moves will not only be determined by inflation development, but also the moves by the global central banks, as I said earlier. As most rate decisions are witnessed in the past, the rupee has not moved much after the announcement, seems somewhat stable in a 79 and 79.80 range. We had big intervention from RBI last week at 79.80 as well. So market is very clear that upside is capped for now, but interest from importers is definitely higher below 79. So we have the parameters set. At least today also, I think we will be in a narrower range because tomorrow we have a holiday, bank holiday in the bank in the forex market. So we will of course look at how the FI numbers pan out, because already touched 2 billion, almost 2 billion in last 1 week, and oil prices have come down substantially. I end this with a slight expression of slight bias on the lower side for the Tuesday. And thank you, Shikhar.
Okay, wonderful, JK. As usual, the numbers were of the key importance, and as JK mentioned, the jobs number or the unemployment number by US economy was blockbuster. Now, what does this transpire into, folks? Is the US economy, if not doing extremely well, going by past economic data, these numbers do bring in some sort of relief for the economic performance as the jobs continue to stay good, and this further, pushes on the fact that there is still some probability of a better rate hike if not recession is coming in by the central bank. What needs to be seen further is the kind of inflation numbers that we see from that particular economy to give further judgment of what should be the rate hike by the central bank. Coming on to the domestic side, as JK mentioned, our central bank was quite keen on protecting or reducing the volatility in the currency, even though we've seen quite high volatility. But interesting thing, we are being seen as an attractive location by the foreign investors, and that's what the central bank was looking for. Our USD 2 billion flow was quite good for the Indian markets. Let's see how things go about in further updates. We'll come up tomorrow again with another round of fresh updates. Till then, thank you so much for listening.